Jeff Reeves, one stock you like as a frugal investor is Check Point Software. Clearly, there's been a lot of problems with hackings, whether it be at retailers or at banks. So why is Check Point the best way to play it?
Well, I think cybersecurity has a lot of room to run, and it's not just the hacking, too. The Department of Defense has doubled its spending on cybersecurity this year to about $500 million, so there's a lot of growth there. There's also a lot of small players, though, that are a little bit riskier. The reason I like Check Point is because it's pretty established, it's profitable, it's got zero debt, $900 million in the bank, and it's not a nosebleed valuation like some other tech stocks. The forward PE is about 17.5, so I think it's a good way to play growth, but at a fair valuation in this space.
And we've seen a lot of growth in Teva stock. That's up around 30% year to date. Still pays a pretty nice dividend, I think around 3% or so. So tell me why you think this is going to go higher.
Well, I really like healthcare as kind of a broad, stable play for people. Teva actually has a beta of about 6 right now, 0.6, so it has less wiggle than the rest of the market. But that, like you said with the share price year to date, that doesn't mean that the shares can't really grow. Its kind of shtick is a generic pharmaceutical company. There's no patent expirations to worry about or anything like that, so it's just worrying about selling generics at home and abroad, big emerging market business, and that I think is where the money is to be made, because these really mature pharmaceutical companies, they're not as agile as Teva is getting into these new markets via acquisition or what have you. So I like the dividend, I like the fact it's got a low beta, but I think there's also growth there, particularly in emerging markets.
And then finally, you're a fan of Discover Financial. We've been hearing a lot about MasterCard and Visa working with Apple on the new iPhone 6 and working towards a cashless society. What's Discover doing?
Well, Discover actually, it's interesting. There was a consumer satisfaction report from J.D. Power. They're just as pleased, their customers are just as pleased with them as they are with American Express. It really is a brand that people believe in. And Discover's been kind of running with that. They've gotten more agreements with merchants to get their card accepted in more places. They've also branched out into lending like mortgages or student loans. So they're really pushing ahead. They're smaller than some of the other guys, but I think that also means they have more room to run in that respect. They're a very stable company, and they don't pay a lot of their earnings out in dividends. I think it's a big dividend growth play as well as growth for the share price.
All right. Thanks a lot, Jeff.
Thank you.
And thank you for watching The Street.